The two types of mortgages are principal and interest only. The way a principal and interest or P&I loan works is that you make regular payments which pay the interest but also pay back the principal of the mortgage. So the mortgage balance is going down on a regular basis. Now this is very common for an owner-occupied property because you want to get that loan paid off. The second type, interest only, is exactly that. You're just paying the interest and the loan balance will stay the same. So this is a cheaper, more affordable option because you're not actually paying money back to the bank, just the interest. So this is more common with investment properties. Table loans are structured so that the repayments are the same all the term of the loan. So for example, if you're paying $500 a week, your payment will be the same now and in 30 years time. And at the start, you'll pay very little principal off, and at the end, it will be mostly principal. The most popular mortgage, again, for an owner-occupier is principal and interest, but for investors, it's generally preferred to go interest only. That's the most common if you're going to be a property investor for your investment property loans. The reason that interest-only loans are the preferred option for investors is because number one, it's more cost effective. So your mortgage is generally your largest cost. And so to bring that cost down by not making principal payments helps with cash flow quite significantly. And the other reason is it's often more tax advantageous to have an interest-only loan. So to give you an example of how the cash flow differs from loan types, if you have a $500,000 mortgage at 3% interest rate, if that loan was interest only, the repayments are about $290 a week. If on the other hand, it was a principal and interest loan over 30 years, that jumps up to $490 a week. So there's $200 going to principal, so it increases your cost per week quite significantly. If you have any personal debt, it's important that you pay this off before paying off any investment debt. And this is why you'd have an interest-only loan for your investment properties. Now, this is because any personal debt is non-tax deductible. Any investment debt is tax deductible, so it's effectively cheaper than your personal debt. So, again, what you want to do is have your investment properties on interest only if you have any personal debt, and when you've paid off all your personal debt, then you can look at whether or not it's beneficial to pay off any investment debt. It's important to recognise that the IRD don't consider your principal payments an expense because essentially they're a form of savings. You're paying back the bank to build your equity in the property rather than them being a true expense. So you might have a cash flow deficit because you're paying down principal payments through a principal and interest loan. However, if your rent covers all your costs and makes a profit after the interest payments, you could be cash flow positive from the IRD's perspective and have to pay tax as well. Now let's look at a cash flow example of someone choosing between an interest-only mortgage or a principal and interest mortgage. Now in this example, we'll assume that the investment property at the moment makes a profit of $2,500 a year. Now we'll ignore depreciation just to keep it simple. So your tax on $2,500 positively geared is $830 in the top tax bracket. So they've got to pay $830, which they can do out of the positive cash flow, unless of course they turn it into a principal and interest loan. So if the principal payments are about $10,000 a year, that means that this property will actually be negative cash flow of $150 a week to account for the extra $200 that's going on to principal. Now remember, the IRD don't count the principal payments as an expense. So although this property is now cash flow negative, they still have to pay the $830 in tax as well as the $150 a week top up that's required. A common question we get asked is whether or not you can have an interest-only loan forever. And the short answer is no, but maybe. So interest-only loans are generally approved for 5 years at a time, and this is for an investment property. So in the past, banks have given interest-only loans for owner-occupiers, and you can get them if there's a valid reason. For example, you're buying one house and selling another, so there's a bridge loan, or you're building a house and you need to bring down your expenses. But generally for owner-occupied loans, you're not going to get those a lot in the future. For an investment property, it's a different story. So banks will look at this and you have to reapply every 5 years. Now just remember, the bank might not necessarily approve it. And you want to be able to use someone like a mortgage broker to take you to another bank if your bank says no. So again, it's really important to have that independent advice so that if one bank says no, you can always go to another and keep renewing that interest only. A common question is, how am I going to make money if I don't pay down debt? Now just remember, your mortgage is going to stay the same, but your house value is not. So over time, property prices in New Zealand go up by 6 to 7%. Now we work on a growth rate, generally speaking, of 5%. So if a property is worth $500,000 today, in 15 years' time, it's quite likely that that'll be worth $1 million. Now at that stage, you might choose to sell it, pay down the $500,000 mortgage, and you take the $500,000 as profit.